Isn't it a little difficult for you all to understand how to manage your own money, but you don't know the way, or you find that your money is quickly losing its value? Hi, I'm Vicky. If you have faced similar kind of challenges, I have come to offer you a solution based on my knowledge and experience in investment banking, where I will explain the risk and return of various capital market instruments in the financial market as part of an educational initiative. Your savings are subject to tax and inflation. Inflation means price rise, which is currently, let's say, 3.7%. So if you have 10,000 rupees today, its value after 1 year will be 10,000 minus 370 is equal to 9,630 rupees, meaning the value will decrease. Your FD return is consumed by tax and inflation. But if you invest the same amount of money in government securities through the RBI Retail Direct app, you might get a return of up to 10% returns based on ratings. For this reason, let me know in the comments section if you are interested in a separate video about fixed income. I have added the screen recording for you so that you can also get an idea of how the live market works. Without understanding the concepts, if you start trading, you might face loss, which will lead to mental unrest. My goal is to guide you to advanced level of financial education through this video series from our new financial education platform. In this slide, we will cover the following topics. First, what is option trading, meaning, example, and its types. Secondly, market trend, which shows how the live market works and reason behind this. Third, we will see how we can earn money through option trading. Fourth, we will discuss the advantages and disadvantages of each market participant. Fifth, I will share with you the steps I check before trading. Lastly, I will share the topics which will be included in our next video series. SEBI according, 91% of traders lose money in options trading. So today we are going to discuss how we can avoid loss through this video. Institutional traders use money in option trading not only for hedging purposes but also to generate daily basis income. Options are considered as fixed asset as the longer you hold them, the more their value tends to go to zero. In options trading, you need to focus on making consistent profits when the market is in your favor rather than making quick money overnight. For example, in car insurance, when you insure your vehicle by paying a certain amount known as the premium amount, and in return, the insurance company promises you a claim amount known as the coverage amount in case of any damage. Similarly, insurance selling companies like LIC cover a part of the risk based on that coverage amount, which they need to pay in case the vehicle gets damaged. However, if the vehicle does not incur any damage during the policy period, then your risk remains with the premium you have paid. Now we'll see what are options. An option is a type of financial instrument whose value is based on an underlying security or index, such as the Nifty Index, which is a basket of top 50 companies listed on the NSE. Therefore, the option contracts we have will be based on the Nifty Index. If we predict that the Nifty will go up, then we will buy a Nifty call option contract. And if we predict that the market will go down, then we will buy a Nifty put option contract. Similarly, if we want to buy a Reliance option contract based on whether the Reliance stock will go up or down, we will purchase the Reliance option contract accordingly. Disclaimer: the video is solely for educational purposes only and to provide information and is not intended to give any advice. In trading, there are two types of options: call options and put options. When you analyze the market and think it will go up, then you should buy a call option and invest money in the rising market. Similar to how I demonstrated in the screenshot, where after breaking a higher high, you can enter the next candle and set a target at the next higher high. And when, according to your analysis, you believe the market will fall, you should invest money in the declining market by buying a put option. You will enter the next candle that forms after breaking the lower low and can set a target at the next lower low. Only three ways a market can move: uptrend, downtrend, and sideways. If your analysis suggests that the market will go up, then you need to buy the call option premium. If your analysis suggests that the market will go downtrend, then you need to buy the put option premium. Then the third situation arises where the market is not able to uproot itself and stuck in a band. This situation usually happens when an important decision is awaited from news, like the recent tariff deal between India and the US, which had kept the market sideways before. For example, real life situation like war between two countries, chances of increasing gold prices are high, while the stock market may experience a negative impact, as we have seen during the recent Iran Israel war. Additionally, investors tend to invest in gold
as a safe commodity in war kind situation. If you are also thinking of investing in gold, you can either invest in physical gold or buy gold ETF or sovereign gold bonds, where you can enjoy the benefit of both the increasing intrinsic value of gold and tax benefits.
Next question is how to earn from option trading. Since there are two players in the market, buyer and seller, these two players make the market move, and whichever is more powerful tends to take the market in their own direction, leading to a trending market, whether bullish or bearish. However, when the market players have a strong position on both sides, the market remains range bound, resulting in a sideways market. In a sideways market, when the price does not break above or below a certain range, buyer may lose their money because they would expect the market to go up or down. However, when the market does not move in such a way, it leads to theta decay, causing the premium value to decrease, resulting in a loss for buyers and a profit for sellers. Currently, I want to tell you an important fact that in a sideways market, sellers have control. Suppose I'm trading with an amount of 10,000. The risk of loss on this 10,000 will be limited to what I can control with proper risk management, including stop loss, and my profit can be unlimited. Sometimes you can turn 10 times your 10,000 into 1 lakh from your own capital. And the sellers are institutions like SBI, LIC, Government of Singapore, or large traders who trade with minimum of 25 lakhs. In this condition, the profit is limited to their capital amount, which means they can make a maximum profit of 25 lakhs from 25 lakhs. But if there's a loss, it can be unlimited and it might wipe out the 25 lakhs. According to Investopedia, in the option market, 66% of the market favors sellers and 34% favors buyers. If you understand this well, you will succeed. Despite the Indian options market being closed on Saturday and Sunday, the market is open 365 days, taking into account the crypto and the forex markets. Out of 365 days, sellers earn profit from option trading for approximately 240 days, while buyers earn profit for approximately 135 days. Immature buyers experience losses for 240 days due to trading without proper analysis, such as failing to check the PCR ratio. So, you don't need to worry about what the PCR ratio is because the PCR ratio shows whether the market is sideways or a uptrend or a downtrend. And I will cover these aspects in this series. It is important to remember that if you trade in a disciplined and proper manner, you can definitely make money. If you trade without discipline and strategy, you could end up losing your own money. If you have lost money in the market, it indicates that someone has predicted the opposite of what you have predicted and earned profit, which is your loss. For example, if you are aware about the land that in the future a school or shopping center is about to be built on near to that land, therefore you can buy the land now so that when the school or shopping complex is built near your land area, you can earn a higher profit by selling it in the near future as the cost of the land will increase because of this factor. Let's take a practical example where Rekha Chunjunwala, the wife of late Rakesh Chunjunwala, a great Indian stock investor and trader, as she was aware about what's happening in the day-to-day market, she saved an approximate of 334 crore loss by selling her entire stake in Nazara Tech just before the Online Gaming Bill 2025 passed in Rajya Sabha. If there is a seller in the market, there will also be a buyer. That is where the contract will form. So, whoever bought the shares at that point of time, when the Rekha Chunjunwala sold her shares, faced a loss because they were expecting the stock to rise in future and they would earn a good amount of profit by buying at a lower price and selling it at a higher price. That's why awareness of daily market events plays a vital role in changing the market sentiment. For your understanding purpose, I have included a screenshot of the option chain in the slide. By following the provided path, you can obtain the option chain data. Basically, the option chain keeps our market data where all the contracts in the market are visible, such as how many contracts are listed on the call and put side in the NSC, at what rate the contract is trading, how much volume of quantity is being dealt with, and many more. However, to understand this, it is essential to know how the underlying index changes according to the strike price, how the premium changes, and so on. For this reason, just to give you an idea, I have introduced this to you. And since this video is a series, the next video will be what an option chain is, how to read the option chain, and how major traders take decisions based on these insights. Please let me know if you have any questions or need a video on a specific topic in the comment section. Risk and reward are crucial practices where the risk is how much loss you can bear and the reward is the profit you are aiming for. So, suppose I have bought 100 quantities at 20 rupees, which cost me 2000 rupees, where I am ready to take a risk of 500 rupees and my stop loss will be at 15 rupees in case of loss. If, according to my analysis, the premium will rise to 30 rupees, then my target price will be 30 rupees. Thus, I am willing to take a risk of 5 rupees to gain a profit of 10 rupees, which will result in a risk reward ratio of 1:2. If you trade without a stop loss, your capital will slowly but surely diminish. Things that I check before trading. My intention with this slide is to share the points I examine before trading, which I believe will be useful for all of you. Points like current news, government policies, international relations such as the recent BRICS summit, and the economic reforms such as the recent GST rate cut. The Singapore Nifty, which is based on our Nifty 50 index, provide us with an idea of how the market will be open prior to its opening. I have shared the link where you can check SGX Nifty. Next is sensible FIDA data. FIDA in the stock market are analyzing the trends to understand the direction of the market based on information available and access its capacity to predict. We need to note that if FI takes the initiative to move the market, following the direction can potentially increase profits, while going against it can increase the chance of losses. According to the table data, if FI and Pro have similar bullish sentiments, there is a chance of upward movement in the market. If they are bearish, the chance of bearish sentiment in the market. Client scenario is opposite, and their market scenario data is not as important. Next is the put call ratio, which shows us the direction of the market. If the PCR is below 0.5, we trade on the put side, and if it's above 1, we trade on the call side. And if it stays between 0.5 to 1, we should not trade as the market will remain sideways. Support and resistance marked through option chain data will tell us the chances of trend reversal at which strike prices. The implied volatility of premium indicates that if IV is above 25, the market will favor buyers. If it is below 12, it will favor sellers. In the next video, we will learn about technical chart reading to check whether the market direction is bullish or bearish, option risks, option chain, PCR ratio calculation, India VIX, capital market instruments, and the smart money concept. My objective is to empower young people, housewives, and adults so that they can enhance their financial education and analyze how daily news impacts the market, which is crucial before starting to trade. I hope you find this video helpful and I request you share it as much as possible so that more people can start learning these concepts. This video provides a free opportunity for them to learn about option trading. Also, don't forget to like and subscribe to ensure you don't miss any of our upcoming videos. Please click the bell icon. Thank you for watching this video.